Assalamualaikum. My name is Aiman Fazana binti Azidi. So I want to present about green bonding development and infrastructure debt financing. So um, green bondings are seen to provide a solution to many the infrastructure issue affecting our economies today. The structure of a green bonding is designed and built in just a way that is use a few resources during construction and operations. After it's built, the structure continues to decrease environmental impacts, generate economic advantage, and improve social and well-being results. Green bonding development on the other hand initiates financial management for systematic finance, one of which is debt financing. This is because financial management is critical for our corporation when investing in a project. So this is a type of debt financing is bonds, bank loan, commercial credit, and less financing.
My name is Siti Garunisa binti Hashim, CN 220025. Today I will present about advantage and disadvantage of debt. Encouraging green financing on a massive scale implies that green or environmental initiatives get priority over usual business investment that may or may not be sustainable. Focusing on a financing leads to transparency and a regular flow of investment into environmental objective. The growth of this type of financing will be helped in the creation of more jobs and business opportunities. Next, the disadvantage in this financing, often the short-term time horizon of the investor does not match with the long-term green investment. There always remain an issue with regards to proper coordination, cooperation and alignment of financial and environmental objectives. Each would like to pull the trigger to prioritize its own objective. Next, we can see the debt instruments. There are two types: long-term debt instruments and medium and short-term debt instrument. In long-term debt instrument, there are debentures, bonds, long-term loans, and mortgage. Meanwhile, the medium and short-term debt instruments has working capital loans, short-term loans, and treasury bills.
Assalamualaikum warahmatullahi wabarakatuh. My name is Siti Nur Shafika binti Ahmad Safawi. So I will present company source of capital and budgeting process. So a corporation can raise money in one of three ways: by selling shares, taking on debt, or using a combination of the two. An ownership share in the company is represented by equity. The shareholder receives a claim on future profits, but there is no obligation to repay the loan. Equity holders are the last to get money in the event of bankruptcy of the company, but a business might opt for debt financing, which comprises selling fixed income instruments to investors in the form of bonds, bills, or notes to raise the money required to boost and extend its operations. When a business issues a bond, the lenders, retail or institutional investors who buy the bond and provide the business with debt financing do so.
Factors influencing debt finance in the development of green bondings. Factors impacting debt financing include corporate, virtual or specific issues, economic ones, and country-specific factors. These factors empirically influence corporate debt financing decisions either positively or negatively. Corporation-specific factors impacting debt financing include corporations' profitability, size and growth, assets nature, no debt tax shielding, liquidity, and bankruptcy risk. Other corporate characteristics such as corporations debt risk, company risk, and access to financial markets, the gender of the finance manager, and the compositions of the board of directors, or those to have an impact on that financing. Corporation-specific factors impacting debt financing include corporations' profitability, size and growth, assets nature, no debt tax shielding, liquidity, and bankruptcy risk. Other corporate characteristics such as corporations debt risk, company risk, and access to financial markets, the gender of the finance manager, and the compositions of the board of directors, or those to have an impact on that financing. The relationship between debt financing and investment. Investing or putting money or capital into a business with the intention of profit is the direct source of corporate performance. The impact of debt financing practices on investment has become a contentious issue. Recent Western research indicate that debt financing has a hard limitations that can inhibit the conduct of manager portion personal profit through investment expansions, and then reduce the agency cost of share, so boosting investment efficiency. Corporate investment and debt financing. A firm, according to principal agent theory, is a nexus of a series of contracting connections among persons rather than a single economic entity. There are disagreements among the company's stockholders. On the one hand, a conflict between stockholders and debt holders, which result in other investment and assets substitutions. On the other hand, contingent debt governance can reduce over investment behavior caused by conflict between stockholders and managers, large stockholders and small and medium-sized stockholders, and new and old stockholders. Structure of debt majority and corporate investment. The longer the loan majority structure, the more acute the shareholders creditor tensions. Short-term debt as compared to long-term debt can readily limit the free cash flow controlled by managers, which can restrain managers over investment drive. In a simple terms, short-term debt can be better controlled and productive investment than long-term debt. Lastly is corporate investment and debt category structures. The impact of debt category structures on investment from the perspective of bank loans and company credit. A bank loan is frequently large in size and has a long maturity period. Business credit is minimal in comparison to bank loans. As a result, the bank's capacity to negotiate with the owning shareholders is stronger than the company's credit. In terms of contracting and investing, investment in non-state-owned enterprise, bank loans can be more effective than state-controlled companies.
Finally, for the conclusion, the most common type of funding for businesses, equity financing with debt financing coming in second. The company can meet its working capital needs and grow thanks to debt financing. The company requires money on a regular basis, and after a certain point, equity financing is unable to provide the total financial requirements. Debt financing provides a helping hand in these situations by meeting the financial requirements of the company. As new businesses expand and establish, players need more money to compete. The sources and demand for debt financing will both rise quickly in the future. Debt financing is usually a far more attractive alternative because the cost is always lower than the cost of equity financing.